Do you agree or disagree with the idea of keeping money in the banks is one of the safest place to have? A lot of people will say yes, and I totally understand why. However, I disagree with this. Actually, it is one of the worst places for your money sitting around, and I will explain to you why in a second. Traditionally, when you have extra money you will keep at home, you may worry about unexpected thief or robber. Therefore, you rather put in the banks where you think is safe. And yes, it is if you don't have too much of it. According to Ida, the average Australian had $39,407 in saving in 2014. The problem is a lot of people keep money in the banks between 40,000 to 90,000. The money sitting there for doing nothing, and you keep working every day to save up. Means you work hard and your money is lazy sitting around in the bank. So I'm going to share with you 6 reasons why you should not keep too much money in the bank. Reason number 1, low or no returns in bank accounts. Money you keep in the banks is the laziest worker ever. Why? Because you all know traditional checking accounts use near 0%. Saving account at big banks usually upper 0.01% to 0.10%. Even high yield online saving accounts maximum around 4 to 5% as the myth of 2025. And yes, money you put in high yield accounts better than other spending accounts. However, the highest interest rate you can raise is just between 4 to 5% compared to putting that money in investment where you can get much higher in return. Depends on where you invest your money. If you invest your money in stock market, S&P 500, 7 to 10% annual return over the long term. Real estate, rental income and property appreciation often 5 to 10% plus. Bond or ETFs, conservative but still often higher banks interest rate. Let's say if you have 100,000 deposit in the banks at 0.05% earns $50 per year. That same 100,000 in the index fund you earn up to 8%, it could earn 8,000 per year and compound even more over time. The point is, you may ask me, but James, you always say in other video, what about saving money for emergency fund? Yes, saving money for emergency fund is super essential and all of us should have it. But you only save from 3 to 6 months expenses. Whatever more than that, you could use that extra money for investment. So you should calculate how much your essential expenses each month. Everyone is different. For example, if your expenses a month is 4,000, so in 6 months it's 24,000. That's all you need to keep in the high yield bank account. The rest you should put out there to work hard for you. This leads to reason number 2, why you should not keep too much money in the bank. Reason number 2, inflation takes over purchasing power. What is inflation? Inflation is gradual rise in price of goods and services over time. It means that the same $200 will buy less next year. For example, we all know if inflation to 3%, some things that cost $100 today will cost $102 to $103 next year. If your bank savings are earning only 0.5%, then your $100 will become $100.50. So the next result, you will actually lose $2.50 in real value quietly and consistently. Therefore, the inflation is like a silent tax on your savings. If your returns don't beat inflation, your money is shrinking in power, even if the number in your account is going up. The next reason will surprise you if you believe your money in the banks is totally risk-free. Reason number 3, Insurance has limits. Depend on which country you are in, your money will be covered in a specific limited amount. The FDIC insure your deposits up to $250,000 per depositor in the US. The FSCS protects up to £85,000 in the UK, and the FCS provides protection to depositors up to $250,000 in Australia. It's important to know the figures so you prepare yourself how much money you deposit in the bank. If it exceeds this amount, you should consider using your money for investment instead. Because, for example, if you hold $300,000 in a single bank account and that bank collapses, you are only guaranteed to get $250,000 back. The rest at risk unless you are structure your bank smartly may be put in a different banks. Not only that, reason number 4 will surprise you more, and that's it. Reason number 4, opportunity cost. Opportunity cost is the cost of not doing something better with your money, and every dollar sitting idle is a dollar not compounding, not invested, not earning. For example, imagine you keep $50,000 in your saving account and earning 0.05%. Over 10 years, it grows to about $52,500. Means in 10 years, you only get $2,500 extra. But again, the inflation is much higher than that. Meanwhile, if you had invested it at the minimum of 7% annually, it could become $98,358 in 10 years. So it is at least $45,858 in lost growth if that money is sitting in a low yield bank account. Therefore, being too cautious can cost way more than calculated investment loss. Now let's move to reason number 5. It is so common and myself which others also experienced it. Reason number 5, trigger your spending habits. When you see too much money in the bank, let's say $30,000 either from your saving or bonuses, then when you want to buy something small, just a pair of shoes, maybe it costs $200, you think it's okay as you have $30,000 in your account. Therefore, when your money has no purpose, just sitting there doing nothing, it can trigger unnecessary spending. See how it works. When you see higher balance, your brain interprets it is having extra or available money. This creates a temptation to buy things you wouldn't normally plan. For example, clothes, dinners, or travels. You are more likely to say things like, I deserve this, I can afford it now, even if the purchase isn't aligned with your financial goal. This can lead to the consequences that extra cash slowly disappear without meaningful improvement to your financial future. Short-term gratification replaces long-term security or investment. So, what is the solution? Automatically allocate extra money to saving, investment, or debt repayment before you tempted to spend. You can also create a spending limit. Transfer anything above a set amount to another account, and you just stick to the budget regardless of how much in your account. Reason number 6 happens even more often nowadays with advanced technology. It's vulnerable to scammers. Having more money in your bank's account also increases your risk of being targeted or falling victim to scams. There are different types of scams, such as investment scams. Scammer may offer you high return opportunity, phishing attacks, email or text pretending to be from your bank, or payment services ask for login information. Fake bank alerts, notifications about suspicious activity that attract you into calling scammer or clicking malicious links. Romance or emotional scam. You are tricked into giving money to someone pretending to be in need or in love. Reality is even highly educated individuals fall for scams. So here how to protect yourself. Use multi-factor authentication to secure unique password. Be skeptical of unsolicited messages or pressure to act fast. Set up the account alert for any unusual or large transaction. Regularly review your account and report any suspicious activity immediately. Don't trust too good to be true offers, especially in investment. So in conclusion, how much money should you keep in the bank? Here is the rule of thumb. Emergency fund, 3 to 6 months of essential living expenses. Keeps in an accessible high-yield saving account. Purpose, job loss, medical emergency or urgent repairs. Short-term goals under 12 to 18 months. For example, for vacations, weddings, home down payment. You should keep in the high-yield saving or obsessed mortgage account. The rest, investing. It could be stock market via the index fund or ETF, real estate, retirement account, 401k or salary sacrifice, bond or conservative income focused funds. A business if you can. Thank you for watching. I have a smart cash strategy template in the link below if you want to use. Like and subscribe for more video about financial strategy. Let's grow together. If you enjoyed this video, watch my next video, 7 Money Habits Keeping You Poor, to understand why you can escape the earn, spend, repeat circle.